In today's episode, General Dynamics and fellow defense company Raytheon Technologies go head to see which one would be the better investment. I will do an in-depth analysis for you and I will show you based on price performance, financials, dividends, company health, valuation and future prospects which company I think wins the battle. Watch until the end to find out who is the winner of this battle. And it is not close. Hi and welcome to my channel. I am Tom from the Dividend Attitude. On this channel I like to do deep dive analysis into mostly dividend paying companies. Today, General Dynamics and Raytheon Technologies. Let's begin. General Dynamics and Raytheon Technologies are both defense contractors working based on government contracts. General Dynamics is a global defense contractor and one of the world's leading global aerospace and defense companies. They sell a wide range of products from submarines and combat vehicles to IT communication systems. In fact, I already did a brief analysis on General Dynamics in episode 23, which is now suggested in the top right corner. A large part of General Dynamics revenue comes from the US government and other military customers, about 85%, with the remaining 15% from international commercial customers. General Dynamics is divided up into 4 business segments: aerospace, combat systems, information systems and technology, and marine systems. And then Raytheon Technologies Corporation, an aerospace and defense company providing advanced systems and services for commercial, military and government customers worldwide. Raytheon actually merged with United Technologies in 2019, forming Raytheon Technologies. With that merger, United Technologies is going back to its roots of aerospace and defense and it has spun off Otis and Carrier. Raytheon Technologies now operates in 4 business segments: Collins Aerospace Systems, Pratt & Whitney, Raytheon Intelligence and Space, Raytheon Missiles and Defense. General Dynamics and Raytheon both dipped hard at the end of March 2020. GD is down around 11% year to date, while Raytheon is still down by 57%. Looking at the 20-year historical price performance, General Dynamics has an annualized return of 8.4% and Raytheon 6.7%, both beating the 5.8% of the S&P 500. So based on recent and long-term price performance, General Dynamics wins this one. And then the beta. According to Google Finance, the beta of General Dynamics is 1.02 and Raytheon has a beta of 1.41. A beta of 1 indicates that the stock moves up and down with the overall market. Below is less volatile and above 1 is more volatile. So GD is clearly less volatile. And then the financials. GD grew revenue by 2.36% over the last 10 years, while Raytheon grew revenue by 4.65% over the last 10 years. The trend of Raytheon is generally up with a dip in 2015. GD's trend is mostly flat except for the last 2 years. So Raytheon wins this one. Good to note though is that while General Dynamics is only hit hard in their information and technology segment, Raytheon seems to be hit hard by the current pandemic across the board. If you liked the video so far, don't forget to give the video a thumbs up and make it turn blue. Also, don't forget to subscribe if you want to stay updated on future content. I will do more of these battles and individual dividend company analysis in the future. The gross margin of General Dynamics is 17.9% and the operating margin is at 11.8% in 2019. At the midpoint of their historical average. Raytheon has a way higher gross margin of 25.9% and an operating margin of 11.6%, where the gross margin is at the midpoint and the operating margin is at the lower end of their 10-year average. Again, Raytheon wins this one based on a higher gross margin and a better long-term average for their operating margin. Net income of Raytheon increased from 4.3 billion to 5.5 billion for a growth rate of 2.96%. While General Dynamics net income increased from 2.6 billion to 3.5 billion for a growth rate of 3.64%. Because growth of the net income is ultimately important for the sustainability of the dividend payouts, GD wins here with a higher growth rate. Then the free cash flow. The free cash flow per share of General Dynamics decreased from 6.79 to 6.18, and that of Raytheon increased from 5.46 to 6.55. As free cash flow is what dividends are paid from, growth is also important here. Based on that, Raytheon wins. So what about the dividends? The current yield. Raytheon currently has a yield of 2.99% and General Dynamics a yield of 2.81% due to the recent price increase. The 10-year dividend growth rate of Raytheon is 6.68 and the 1-year growth rate is 1.25. GD has a much more impressive 10-year growth rate of 10.35% and a 1-year growth rate of 8.27%. Raytheon has a dividend growth history of 27 years versus a 29-year dividend growth history of General Dynamics. Then the earnings payout ratio. General Dynamics has a much lower earnings payout ratio of 39.8% versus the 67.5% earnings payout ratio of Raytheon. The free cash flow payout ratio of GD is a bit higher with 64.6%. Based on year-end 2019 numbers. Raytheon has a much lower free cash flow payout ratio with 44.9% based on 2019 year-end numbers. Raytheon has a much lower dividend safety score of 70 though. The website of Simply Safe Dividends is also showing a growth streak of 0 years as the result of the merger between Raytheon and United Technologies. I'm not sure if that plays a role, but personally I think the streak of growing dividends continued as a result of merger and split adjusted payouts. In the last recession of 2007-2009, the revenue of Raytheon did drop significantly, 11% according to Simply Safe Dividends. So that also plays a role. General Dynamics has a dividend safety score of 97, based on a forward payout ratio of 37%. A long dividend streak and a very low drop during the last recession. Based on the dividend metrics, I declare General Dynamics the winner in this department due to a lower earnings payout ratio, and the free cash flow payout ratio is also going to be lower again based on 2020 numbers, a higher dividend growth rate and a higher dividend safety score. Then a quick check on their ability to pay their liabilities long and short term. The debt-to-equity ratio of GD stands at 0.76 in 2019 and is quite a bit higher than the 0.18 in 2010 due to several acquisitions. The debt-to-equity ratio of Raytheon in 2019 was 0.96, which is also quite a bit higher than their 0.47 in 2010. The latest quarter showed a debt-to-equity ratio of 0.49 though. The current ratio shows us the ability of a company to pay off current liabilities with the current assets. A current ratio above 1 is generally considered good. The current ratio of 1.18 in 2019 for General Dynamics is at the lower end of their 10-year average, but the latest quarter showed an improved ratio of 1.27. Raytheon had a current ratio of 1.08 in 2019, which was the lowest in 10 years. But their current ratio also improved to 1.20 in the latest reported quarter. Then the quick ratio. The quick ratio is comparable with the current ratio, but it looks at the ability to pay off current liabilities with the most liquid assets such as cash and cash equivalents and short-term investments. Again, a quick ratio of 1 is the norm. General Dynamics does not meet that norm because they have a quick ratio of 0.73, but that does not seem to be problematic for them since this is actually at the midpoint of their historical average. Raytheon actually has the same quick ratio of 0.73, but this is at the lower end of their 10-year average. This seems to be quite normal in the defense industry because also Lockheed Martin consistently has a quick ratio below 1. I suspect this has to do with the capital intensiveness of the industry, with higher accounts payable and short-term loans. Because General Dynamics has a lower debt-to-equity ratio and a higher current ratio, they are also the winner of the health check. As an investor, you also want to know how efficient a company is with the money you invested in them. For that, we look at the return on equity. General Dynamics has a return on equity of 27.5 in 2019, which is at the midpoint of their 10-year average. The latest quarter showed a bit lower return with 24.3%. Raytheon has a return half of that, with 13.8 in 2019 and a negative return on equity in the latest quarter. The return on invested capital shows us the return a company makes with the capital they got from loans and equity. General Dynamics has a return on invested capital of 15.1, which is at the midpoint of their 10-year average. Their latest quarter shows a 11.2% return. Raytheon again is much lower with 7.79, the lowest in 10 years. The latest quarter was also slightly negative. A credit rating is important because the better the credit rating, the lower the rates for bank loans can be. General Dynamics has an excellent S&P credit rating of A. Raytheon also has an excellent credit rating of A-, so only a bit lower than GD. With a better return on equity, return on invested capital and a slightly better credit rating, General Dynamics is once again the winner here. Also important to look at is the valuation. First, Fastgraphs. With a current price of $153 at the time of recording, General Dynamics is showing a slight undervaluation on Fastgraphs. Based on estimates of 19 analysts, you could look at a return of around 15% annually until the end of 2022. Analysts have been wrong a few times in the past though. Raytheon seems fairly valued at $63 and is right around where the market normally values Raytheon. Analysts expect a big dip in earnings this year with a large uptick after. If they are right, you will be looking at a 14.4% annual return. but I would expect quite some volatility. I always like to look at different valuation methods to get a good feel for the fair value. In my valuation playlist, now suggested, you can find several videos on different valuation methods. For this video I will also take a look at the intrinsic value estimate on Finbox, which is the result of different valuation methods combined. The dividend discount model, the discounted cash flow model and a few more. According to Finbox, the fair value for General Dynamics is at 191, an upside of 24%, but the spread of estimation is quite wide, 124 to 226. So that is something to keep in mind. Raytheon is valued at $69, an upside of 10%. According to Morningstar, the PEG ratio of GD is at 3.0, which would point to severe overvaluation, so that is quite interesting. For Raytheon, no PEG ratio is shown on Morningstar. So based on these valuations, General Dynamics seems to be the most undervalued of the two, meaning GD also wins the valuation battle. But the past is only an indication of what the future might bring, so let's take an actual look at what analysts are expecting. For GD, analysts on Yahoo Finance estimate an average EPS of 12.05, Fastgraphs 12.12 and Finbox 12.06 by the end of 2021. So around 12.05 would be a safe bet, which would be an upside of around 9 to 10% based on the estimates of around 11.05 for fiscal year 2020. Raytheon is expected to have an EPS of 3.83 according to Finbox and Fastgraphs, and an EPS of 3.85 according to Yahoo Finance. Based on an average estimate of an EPS of 2.86 in 2020, that would be an upside of about 34%. However, Raytheon's EPS is expected to shrink significantly this year, as we also saw earlier in the valuation part. Based on a straighter path to growth of 2021, less downside, I declare GD to be the winner of this part as well. So General Dynamics is the clear winner here and is looking like an attractive investment right now. But I will do a bit more research into the inner workings of the company before I invest. One other thing to keep in mind is how Raytheon will develop after the merger of this year. If you have enjoyed this comparative analysis of these two dividend aristocrats, don't forget to like the video and subscribe if you want to stay updated on future content. Until next time, bye bye.